Let's talk more about this rotation and where stocks go from here. Joining us this morning is the Yardeni Research President, Ed Yardeni. Ed, great to have you back. Took note of your note last week where you went to 5,800. You used the word melt up. Has any of that changed?
Not really, no. Certainly looks as though we have not just a melt up, but a broadening melt up. That's different from what we had in the late 1990s. In the late 1990s, we had a melt up which stayed very, very concentrated in technology, particularly large cap technology. This time around, the melt up that we've seen in technology and communication services, at least in the past week, as you folks have noted, seems to be broadening out to the mid caps, the small and mid cap companies. And I think Don was very accurate in pointing out that it has been some short covering and certainly a concentration in biotech and in regional banks. So it's widened out. I think the widening out, though, is going to increasingly focus on the S&P 473. In other words, money may continue to come out of the Magnificent Seven, or money won't go into the Magnificent Seven, and will get redistributed to the rest of the S&P 500. The problem with the SMID caps is earnings. The earnings still look pretty punk. They've been kind of flat for the past 2 years.
Exactly. And you did say last week that you were wary of Fed rate cuts because of the sideline cash that it would draw into equities. Explain that.
Well, I'm not in charge of the Fed, and I rarely go out of my way to tell the Fed what to do. But as a strategist, I think that if the Fed moves forward here on lowering interest rates, and it looks like it's locked itself into that pattern, it looks like they're pretty much committed to cutting rates in September. I mean, the markets will be totally blown away if they don't, because now the expectations is 100% that there's going to be a 25 basis point cut in September. So that's in there. And that certainly explains this melt up and now this broadening that we're seeing in the market. I just don't want to see a melt up, because the problem is, as an investment strategist, then I got to be smart enough to tell everybody when to get out when it's about to melt down. I much prefer civilized, gradual bull markets. But hey, look, it's not what is good for me. It's what the market intends to do. And right now, it feels as though the market is pricing in at least one. Well, actually, the market's pricing in 5 Fed funds rate cuts of 25 basis points over the next 12 months. That's what it's doing.
But Ed, there's a difference between broadening and rotating. And today it feels like one of those sort of uncomfortable days, at least if you're in the NASDAQ or any tech stocks, which NASDAQ's down 2.4%. The Dow is higher. So how do we know which one it is and what's healthier?
I think it's broadening. I think it's healthy to see the NASDAQ have some sort of sell-off. It's just been going straight up. So seeing some profit taking in that index makes sense, especially since there is actually some mildly bearish news, such as you folks mentioned, that the Biden administration may try to make it even harder for ASML and other semiconductor equipment manufacturers to sell to China. In addition, former President Donald Trump is talking about asking the Taiwanese to foot the bill for defending them vis-a-vis mainland China. So there's bad news out there. The market's taking some profits on it, and those profits aren't totally leaving the market. They're quite the opposite. They're going right back in.